Build Prince George's is a proud sponsor of Level Up. Build Prince George's, strengthening diverse local and minority businesses 360 degrees. 5, 4, 3, 2, 1.
I'm Denise Smith, and welcome to Level Up. It's been a while, but we're back and ready to go. Look, it's tax season, so there's no time for games. We've got a lot to cover and too much to talk about, and I know you want to know about your stimulus check. So let's get it started. Here to get you prepared for tax season is returning guest Shuwanda Williams, President and CEO of Accounting and Tax Solutions. It's been a while, so thank you so much for being here, Shuwanda.
Thanks for having me, Denise. It's always good to be with you.
So, let's get right into this. I think what's at the top of mind of people all over the country is the stimulus checks. Can you talk about how the stimulus payments from the government may be impacting the way we file our taxes this year?
Yes, they are definitely impacting. Impacting from a point of view is this. And I want to just say up front, first of all, the stimulus payments are not taxable income to you. Okay, so don't worry about that. It's not taxable. But you have to account for the stimulus payments in your tax return for 2020. If you may recall, back in around April and May of 2020, we would start receiving stimulus checks. The first round of payments were giving $1,200 for each adult and $500 for each child under the age of 17. Then they were received either by direct deposit right into your bank account. For some people who may have closed accounts or got new accounts, they got a check in the mail. And some people actually received a debit card. Many people even thought the debit card was just false advertisement. And some people just threw it away, not realizing the IRS would send you a debit card. So you received that first payment. And then by the end of the year, starting December, they added another part to the stimulus because the economy needed. And this was a $600 payment, okay, for an adult and child under the age of 17. Now, again, we had the same scenario. Those payments came in either December 20, January 21, or February of 21. And even though they are in 21, they have to be accounted for in the 2020 tax return. So that's what
that's good to know. That's good to know.
That's why we have we call them the economic impact payments, EIP. So now we have EIP 1 and EIP 2 that's accounted for in the 2020 tax return. Our president just issued a third round of EIP now, and this is the new $1,400 that everyone is anxiously awaiting for. And many people have already received their $1,400. This particular payment is a little bit more liberal because it's for any dependent that you have on your tax return, whether there's under 17, over 17, or a parent you may be claiming. So there's a $1,400 payment per individual. Again, there is qualifying factors of income at each level. And these amounts should be, they've already started going out, and they're going to continue to be going out over the next few weeks. And hopefully everyone's going to have their third stimulus payment very soon.
Well, what about the distribution of the statements of the stimulus check? If they did not file a return where they can put their bank account on file and get it directly deposited into their bank account, how else are they going to receive?
They can go on the IRS website. There's what's called the non-filer, okay? And if you qualify, you can put in your information. It will tell you if you qualify, and you can give the appropriate information there, and they can set up where you can get your payment and get it deposited in your account. So there is a recourse for people who did not file. But what it did do, the stimulus, it encouraged many people to get their taxes filed. because this last stimulus is going to be based on 19 or 20 taxes. So it's encouraging everyone to get their taxes current so that they can make sure they qualify for the stimulus payment.
What about when it comes to unemployment benefits? Is there any impact on our taxes if you're receiving unemployment?
Yes, there is. First of all, you have to report unemployment. And last year with the CARES Act, of course, there was that additional amount of $600. So there were huge unemployment benefits last year for the people who were able to get them. Recently, in this last legislation that was just passed by President Biden, there is an opportunity to get some of the income from the unemployment deferred. There is right now $10,200. You can be relieved of taxes on that first amount. However, there are many people who have already filed their 2020 taxes. So right now, the IRS will be giving us some forthcoming information as how to adjust those. They are recommending that you don't do any amendments to 2020 just yet, but we're waiting, information because it literally just happened, like March 12th. So, we have to wait to make sure that is taken care of. But yes, there is recourse on some of those unemployment benefits that were received in 2020.
What about COVID related benefits like childcare? Everyone, I mean, the COVID has impacted everybody across the country in many different ways. But one of the things is those who have been forced or volunteered to telework, we may not have had as many expenses for childcare. How does that work with our taxes?
Well, the point of it is you can still use those childcare expenses up to $3,000 per child, two children, $6,000 if you actually use the money. What it did do with the CARES Act, it gave family benefits because a lot of parents, if they experience the unfortunate of having COVID, they had to be off work. So as an employer, you could get the leave for COVID to be off work, which was a good thing. However, for the most part, benefits itself, childcare benefits, you have to pay the expense as usual. So therefore, you do get an expense of what you're entitled, to pay for childcare expenses in 2020.
But if you did not have to pay as much in childcare, then you're not going to get as much of that benefit, right?
Not for the childcare benefit itself, but you still get your childcare credit, which as a result of the great change that happened in 2018, if you have a child up to the age of 16, you get a $2,000 credit per child. Okay. Now, the thing that's good with this new legislation that has come forth that's just started under President Biden, that child care credit is going to be increased to $3,000 for a child under 16, and for $3,600 for a child under the age of 6. And that is a tremendous benefit for families. And the other part of that benefit is this. They're going to start in July sending some of those checks out. Half of that benefit, you're going to receive like a prepaid advance on it every month in the form of a deposit or check. And again, you're going to have to account for that in your 21 taxes. Yes, so the child care credit is really going to be important for working families. And that increase is going to be needed because it gives you the money right away. And you will get half of that benefit in 21 that will have to be reported in your 20 when you do the taxes in 22.
So we're going to get that credit. We're going to see that credit in advance of our filing.
Exactly. That's what they're giving you. They're not allowing you to wait for tax time to report it. They're going to give it to you before time. So you will have the benefit of using the credit for taking care of your child expenses now.
And is that only going to be for parents who meet a certain income level?
Yes, there are some income limitations with that also. Mm-hmm. But for the most part, it's normal. I do believe in that neighborhood, like 150 for marriage filing jointly. I forget the actual exempt amount for single. But the bottom line is it's an increase in the credit. And most people will definitely, if you have small children, you're going to be able to qualify for it. Mm-hmm. So what they're giving you a little bit of that in advance.
But outside of that qualifying amount, that's the $3,000 amount. What about for those who don't meet that income
Well,
requirement?
what happened is you'll get some of the credit as you get farther away from the top of the line, the income, that credit gets less.
Okay. And will that credit be in advance as well?
Yes. In other
Oh.
words, what it is, they'll look at your income based upon your tax return. That's why it's very important that you get your 2020 tax return prepared, because that's what they're going to be basing that information on.
Okay. And one of the things I wanted to get to is this new way of telling the government, this is how much taxes you need to be taken out of my check every 2 weeks or what have you. Can we talk about that, please?
Yes, you talk about that, Denise. What happened in 2020? The IRS created a new W-4 form, okay? Now, we were used to the typical old W-4 form that did numbers numerically in exemptions. For example, if you had 10 exemptions, they took out the least amount of tax. If you had 0, they took out the most amount of tax. So you just had a number you had to pick when you wanted more taxes taken out. If you were at 2, you go to 1. If you were at 2, you may need to go to 0. With this new form, it's kind of income based, and it's based on your number of dependents and also your ability to itemize. And what it is very difficult because all of a sudden in last year, people start recognizing I haven't changed anything in my withholdings, but they are less now. They couldn't figure out what was going on. Well, what's happening now is this: they need to probably go back and redo their W-4. Now, to help us do that, the IRS has provided a withholding calculator, and you can go right on the IRS website, get the withholding calculator, and it can help you determine exactly how much you should be having withheld based upon your tax status, whether you're single, whether you're married or married filing separately, whatever that is. And sometimes people still have to pay, a little extra in that. But the point of it is it will help you determine it as opposed to trying to just kind of pick, how do I do this? That's the best way to determine. So I want to admonish everyone. If you're having difficulty in the area, go to the IRS website, go in and put in information on the withholding calendar or the withholding calculator, and they will help you, determine the exact amount that needs to be withheld.
Mhm. Okay, let's go back to, are there any, what other related, Trump administration related changes are there to how people have to now file their taxes?
Okay. First of all, what we're seeing in this time, there are no major transformations. What we're seeing right now is maybe like increase in certain items, such as like the standard deduction. Okay, that has been increased. That went up like about $150 for people who were single or married filing jointly, or single or married filing separately, or had a household, and then jointly another $300. So we've seen some increases in that. Also, we are gonna have again, the retirement amounts have increased. You can still put in away in a traditional IRA $6,000 a year. If you're over 50, an additional 1,000 up to 7,000. You can put in your 401k now up to 20,500. If you're over 50, an additional 5,500, and make that amount $26,000.
That makes a big difference for people who are trying to save for retirement, huh?
Well, it does, because if you think about it, one of the things that happened in that bill is that many people who itemized, they lost deductions, okay? And what happens now, if you think about it, the way now to reduce your tax liability is to have your income lower. So I always encourage people, let's pay yourself up. Every time you get an increase the amount you're putting in your 401k or your 457, whatever that retirement planning you may have, because as that is increasing, you can increase to the point that hopefully you can max out your savings. Mm-hmm. And on top of that, many of the companies are matching it, some 3%, some 6%, And even some companies have stopped even the matching requirement. But regardless of that, I want to encourage everyone to make sure they are saving and keep on increasing the amounts in their 401k. They're tax deferred now, and they won't be taxed until you take them out somewhere down the road later.
And I have a question about that because, you know, when I hear instead of being taxed now, we'll be taxed later. Will the tax amount be the same? Like if we were to take it out now,
That's a great question, Denise. So let me tell you what's happened. One of the things that's happened lately is the tax brackets have changed. It started in 18 when we had that major tax cut. For example, right now our tax brackets go 10%, 12%, 22%, 24%, 32%, 35%, 37%. Now, if you look at that, there's a big jump between the 12 and the 22. Now,
but before you explain that, you named all of those percentages. 12%, 22% of what?
Taxable income.
Okay.
That's your income after you've taken all your deductions that you're eligible for, if you itemize. If you don't itemize, it's the standard deduction.
In other words, I would have to pay 12% of that after all of that to the government.
Correct.
Okay.
Now,
okay. I'm clear now.
What happens is this. If you think about it, the majority of middle class America is in this bracket between this 22%. And the issue of it is this: most people in retirement expect to be paying lower taxes. And however, that is not the case. I'm finding so many people who are retiring, they have very good pensions and they have planned wisely for retirement, but they still find themselves owing large amounts in taxes because the taxes have not changed. Everyone thought that, once I retire, I'll be paying a lower tax bracket. That's not the case. It's still the same tax bracket. So what's happening now is people taking money out of retirement because they have to account for their taxes now because these amounts are coming out of their 401ks. They're finding with the taxes being so high, it's very difficult to keep managing this. And as a result, I find people that, particularly in our area here in the Washington metropolitan area, particularly with state taxes and then county taxes, they feel like they're taxed to no end. And even some people want to move out the area just because they want to go to a state that doesn't have state taxes anymore. So I say that to say the tax brackets, it's really somewhat unfair. I'll be very honest with you. Because when you have worked all those many years and you think now you can rest and relax, you still have to worry about taxes and being able to make sure that every piece of income that you have is taxed. Because literally you have to. If you don't, I tell my clients all the time, make sure you have something taken out of every piece of income. Because without current tax structure, that's the only way you're going to end up with not having a tax liability at the end of it.
So, I wanted to talk about donations and philanthropy because a lot of people in Prince George's County pay tithes, a lot of tithes to churches and donations to charitable organizations. Is there anything that we need to be aware of for our tax purposes when it comes to that?
Well, first of all, you don't need to be worried of the fact that your contributions are not deductible because they are 100% deductible. With the new tax law, they were limited to 60% of your modified gross adjusted income. But now you can use up to 100% of your modified gross income for a contribution. So many people give a lot of money away in good times and in bad times. And what happens is the good thing about contributions is if by chance you go over those limitations, you don't lose those contributions because you can they roll over until the next tax year and you can use them again. So I want to encourage people, don't stop giving. Please continue to give because those contributions will continually be deducted.
So if I miss the mark in reporting what I donated in December of the previous year, I can carry it over to the next year.
No. That's not what I'm saying. What I'm saying is if you miss the limitation in terms of your qualifying income, okay? That's what I'm
Okay.
talking about.
Okay.
The other thing when it came to contributions for this year, one of the changes in the taxes is that before you had to itemize to get
Mhm.
a deduction for your contribution.
Okay.
However, in this year of 2020, there is a $300 limit. So therefore, you can use up to $300 if you do not itemize. So you still can take advantage of that $300 contribution.
Okay. Let's talk about filing taxes for business owners. Is there
Okay.
any Are there any changes this year from the previous year that business owners need to be aware about?
Well, first of all, one of the things that business owners need to be aware of when it comes to changes, we have some changes coming up, not so much effective this year, but it really is going to really make a difference next year. One of the things is, of course, the business mileage deduction is going from 58 down to 56 and a half. That's going down next year. One of the things that's happening also in this year, you are limited to 50% on meals and entertainment. And starting for next year, that amount is going to be 100%. So therefore, many businesses are going to like that. But still, we're just dealing with the 50% this year.
Oh,
Most
okay.
businesses will still have the qualifying income deduction as a result of corporations having the 21% that was being withheld or 20% for taxes. They gave that to all types of businesses, whether you're an S corp, partnership, Schedule C, you can still take that 20% as a qualified business deduction on your taxes if you're having, you make it income. So
Mhm.
that's still a great thing for businesses. One of the things for businesses they need to be aware of this year, more so than anything, I think of this time is crucial because as a result of the CARES Act, many businesses had an opportunity to apply for the payroll protection loan. And of course, that does not necessarily affect your taxes. But right now, we have one of those deadlines coming up by the end of March. So, businesses who have not applied for the PPL loan, whether the first one or the second one, it's an opportunity for them to apply, whether you're a sole proprietor, it doesn't make a difference. And one of the provisions that changed, which was really good, you have the option of using your gross income or your net income. So that's going to allow many more small businesses to be able to participate in the program. So I just
Oh,
want to
wow.
put that out there for small businesses because the deadline is coming up on the 31st of March. That's going to be the last day. So if you have not applied for your PPL loan, whether the first time or the second time, please take advantage of those opportunities and look on the SBA website to see all the questions surrounding that. But I want all business owners to be aware of that so they don't miss out on getting those funds that they deserve.
Shawanda, for the PPP loans, and some of them are grants, are those grants taxable?
No, they're not taxable. There was some before initially when they came out. If you're a business, there are some grants that you get that will become taxable to businesses. You just have to look at how the grant is given.
Mhm.
If you're a nonprofit, of course, you have nonprofit status, but some grants will be taxable. Now, when it comes to some of the other part of the PPL loan, many people got what was called the EBIL loan, which was something else from SBA. That's a loan, okay? And those in the PPL program, we know that their loans can be forgiven if they meet the qualification. But
Mhm.
you have to look at the terms of the agreement of your documents because some grants are taxable to this.
What about issues like paying contractors and independent contractors? Are there some differences in how we? Isn't there? Aren't there new forms now?
There's a new
And new.
form, correct, there is. It's for 1099, it's the NEC form. And basically, basis for people that you're paying, fees for in a contract, anyone over $600. But
Mhm.
say, for instance, you're having mortgage, rental assistance, and you're getting a 1099 for rent that you receive for a tenant. You would get the standard 1099 miscellaneous form. So the new
Mhm.
form are just basically for those contractors and those approved non-employee payments that are being sent out. So yes, there are two forms this year. And you may see two forms being used, but the new forms are truly for 1099 contractor pay.
Okay, okay. And it doesn't sound like there's a whole lot of changes when it comes
No, it's
to
not a
small.
lot of changes this year. What we're seeing is an outflow of things that are happening from the major changes that happened in 18.
Mhm.
One of the other things that happens is they have changed some of the Section 129 changes that happen on, say, for instance, special depreciation for businesses. They have upped some of the limits on that. So if
Mhm.
you're purchasing like fixed assets such as equipment, and based upon the classification of it, you may can be able to take more aggressive depreciation. Those are some of the things that small businesses can look to
Mhm.
for 2020.
Mhm.
For the
Mhm.
most part, we're just seeing some tweeting of the things that were rolling out of the 2018 legislation. I'm quite sure as we get towards some of the challenges of this new administration, that as we get towards the end of the year, we're probably going to be looking at some more tax changes. And with the fact that, the government has given out so much money in the trillions of dollars, I want to warn everyone, don't think taxes are going down because they are
Mhm. Oh, that'd be too much to be correct, right?
not too much to ask.
um, yeah. What are some things that people can do to start getting prepared for next year? I got about 2 minutes.
Okay. First of all, I want to say to the small businesses, one of the things that I'm finding out is this: small businesses need to make sure their bookkeeping is in order. That's one of the challenges of small businesses. Come tax time, they haven't really kept good financials. They don't have good profit and loss statements. You really have to look at your information. And I'm telling everyone to go back, go over your financials, your bank statements, look at everything, your credit cards, to make sure you don't miss out on any valuable expenses, that business expenses that you can be done. And a lot of times, because we don't go through that exercise, we miss out on a lot of things.
Mhm.
So, I want to first of all encourage you to make sure your books are good, stay on top of them, keep good records. Number two, you got to do tax planning. You just can't just wait for the end of the year and look at your taxes. You got to look at income mid-year and see where you are. Because the brackets that we're in now, I mean, those are some hefty brackets. And so when you need to make tax payments, it's very difficult to wait till the very last minute, to do so. So it's important that you do a lot of planning. A lot of planning is essential. You just can't, like I said, not look at the information at the end of the year or tax time, but you have to make sure that you position yourself appropriately.
Shawanda, where can people go to find out more about you and your company if they have questions?
They can go to my website, www.actsfin.com, ACTSFIN.com. That's my website. Telephone number 301-386-7700. We'll be more than happy to help with anyone. Just want to encourage this one. This is not the year to just be playing with your taxes. There are too many things in it, too many new changes. I want to make sure you take advantage so you don't have to pay more taxes than you need to.
Shuwanda Williams, as always, great and helpful information. Thank you so much for joining us today.
Thank you, Denise. It's always great to be with you.
And that's our show for today. Again, I want to thank my guest, Shuwanda Williams. This show and previous episodes are posted on our YouTube channel, Level Up CTV. So make sure you go out there and hit the subscribe button. Also sign up for my small business club. I promise once we get past this pandemic, we're going to get out to your establishments to showcase your business on this show. So send an email with the link to your company website to levelup@pgctv.org. Until then, if you would like to see your business on the show, take a selfie. That's a picture of you and your business, and it has to be a picture of you and your business. So turn those cameras around and flip it around and make sure your business is in the background. Send it to me on Twitter at I am Denise G. Smith, and be sure to use the hashtag #LevelUpSelfie. I'm Denise Smith, your host, and I will see you next time on Level Up, where your success is our success.